let me just give you a little bit of background quickly. We're having this conversation here today because both of these gentlemen have concerns, perhaps issues, with the ways our financial markets work, the ways in which they're structured, the ways they're regulated, and the ways in which perhaps too often they fail to serve their intended purpose, directing capital to where it's most needed. Now, Marc Rowan here runs Apollo. This is a firm active in both public and private markets. It originates, it structures, it trades, and in recent years, Apollo has become an innovator in both insurance and in private credit, and in the process has grown to manage almost $1 trillion of assets. Ravi has spent his career in government and central banking, and until 2024, he was the managing director of the Monetary Authority of Singapore, which is to say, he was the boss. And so he brings the perspective not only of a regulator and a policymaker, but now as climate ambassador for Singapore. And Ravi, as many of you in this room know, commands enormous respect from his peers. Marc, the financial system of today, the markets, the major participants, the regulatory structure is very different from the system you knew and navigated when you and your partners founded Apollo back in 1990. Is the system we have fit for purpose? And if not, where is it lacking?
So we've made a massive change to the financial system in 2008. We collectively stared over the abyss and decided to reform. In the U.S., Dodd-Frank, but around the world, we reformed the financial system. And by and large, we achieved the purpose. We made the systemic banks much less important. But while we were focused on the banking system, which was the focus of almost all reform, and most regulators around the world are bank regulators. They come at things from a bank perspective. We really haven't kept pace with what's happened in our markets. So our markets have undergone massive shifts since 2008. So think about the following. 80% of trading, S&P 500. 10 companies, 40% of the S&P. Almost all the return in the market, 7 companies. Really 2 companies. And sometimes I jokingly say we levered the entire return of the U.S. retirement system to NVIDIA. It's not clear to me that that was the purpose, but then we bemoan 8,000 companies have become 4,000 companies. And I would bet you we're going to have 3,500 companies before we have 4,500 companies. And it is not regulatory burden, it is market structure. Why does the world need the next $5 or $10 billion public company when no one cares? And what's happened is other markets, private markets in particular, have grown large enough to be able to provide companies debt and equity for a really long period of time at large scale. Stripe is private, SpaceX is private, OpenAI is private, Mars is private, the NFL is private. It will not surprise me to see 50, 100 really large companies that have elected to stay private because they can. So is that good or bad? I don't know. But it certainly is different than the world that we grew up in, where everyone worked to get to the public markets to be able to raise capital.
So where is that system, in your view, lacking? You raised the question, is it good or is it bad? You said, I don't know, but what is good and what's still bad?
So I'll say it the following way. The U.S. is still 60+% of the world's capital market. And so it is working in the U.S. Draghi has provided a prescription of how Europe might adapt itself, and as Jenny was saying as she walked off, not much of the reform has been adapted.
This is his competitiveness report from September of last year.
And then if you look at capital markets almost everywhere else in the world, particularly in Asia, every capital market's different, but it's actually the same. There are 2 products, bank debt and equity. There's almost nothing in between. And so think about what we're building as a world. We're building infrastructure, we're building energy, we're doing energy transition, we're building the grid, we're doing next generation manufacturing, we're doing defense, and AI and data centers. Almost every one of those things is long dated and complex. The banking system borrows short and is a great short-term lender. It is not a great long-term lender. The equity market is not necessarily the place to do this kind of rate of return investing. And so at the moment, capital is adequate, but Governments around the world, I think, are going to do less. We bemoan, and therefore markets are going to need to do more.
Ravi, you played a role in the development of the system we're talking about as the managing director of the Monetary Authority, from macroprudential regulation to fintech. Now, of course, you're looking at the world through a slightly different lens as the climate ambassador. I'm not trying to say you're responsible for the things that Marc describes, but I want to ask you a version of the same question. What do you think of this system in which you played such a central role? Is it working as intended? What would you change?
Well, it's as with all things in life, some of it is working and some of it is not. What is working, I think, has been the growth of the private markets. And Marc and people like him have been, I think, providing a source of capital that had been lacking in the past. So in some ways, I think the growth of the private markets has complemented what's happening to the public markets, where interest has been waning. And this is the central dilemma that regulators have. Because in the public markets, you have all manner of people, man in the street, retail investors involved and at stake. And so there's a constant tension between investor protection rules. Every time something goes wrong, regulators are under pressure from the public or the politicians to tighten up. And what we have is a very strong burden of compliance, well-intended and in many ways working, but we have to accept that it has raised the cost of doing business in the public markets. And I'm not sure there's a way out of it because investors still need to be protected. You could do it in a smarter way, and I think that's where most of the reforms need to take place. But having said that, I think what we should think of is that alternative sources of capital are emerging, and we should encourage that. And so the emergence of private equity, private credit, these have been positive, I think. What I think regulators need to make sure is that similar risks are addressed in a similar fashion. The advantage of the private markets are that they don't tap the mass deposit base. And so I think the treatment should be different, but there are risks. And so I think regulators need to come up to speed on what those risks are and address them. And I think for some of the issues that Marc raised, the kinds of long-term investments which require patient capital, which requires an element of de-risking, which requires a cost of capital to come down and yet crowd in investors, I think those are the challenges that we need to focus on. And especially in my area of work, where we need to finance a very large transformation of the economy, from energy transition to infrastructure, to building the green industries of tomorrow, and to achieve decarbonization that's necessary to keep the planet safe. We need large amounts of investments there. And I think we need to think of innovative new ways of doing that. Public capital is not going to be enough. Public debt globally is all-time high. There isn't enough in the public purse to finance these infrastructure investments. Private capital is abundant, more than abundant, but it's not willing because the risks are not commensurate with the returns for many of these things. And so we have to think imaginatively of synergizing public, private, and might I add, philanthropic capital into the blend so that you can finance a new type of investments that are required for the world tomorrow.
Marc Ravi has been making the case, and we heard a little bit of it just a few moments ago, that the public markets no longer serve the interests of long-term investors, and so it should be easier for more people to participate in private markets. And it's an articulate, to your credit, Marc, it's an articulate and persuasive argument. The question I have for you, Ravi, is that the answer? Opening access to private markets? Or should the focus be on fixing the flaws, some of which you described, in the public markets? Or maybe is it both?
It's going to be a bit of both. We have to look at how, whether each of the regulations that are in place in the public markets are worth their cost. You always have to measure the benefits and costs. The private markets are not for the faint-hearted. And so I think we need to find ways in which more collective investment schemes can be developed, which retail investors can participate in. my own view is that it is a paradox that we, retail investors invest in single securities, be it in the equities market or the fixed income market, without any restriction. You can't turn it back. But that is a highly risky venture. Diversification is the root principle of all investment strategies. And I think increasingly, if we can have products coming out of the private equity and the private credit market that are collective in nature, that have a balanced risk-return structure, and if you have more of those, then retail investors can participate in those opportunities. And I think that's where we want to probably see the next kinds of innovation happening.
I think it's happening already. I think what's not happening is the regulatory education. And I come back to where, in many instances, the regulatory bodies around the world are staffed with bank regulators. And that does not surprise me, given the history of what has brought economies to their knees. But today, private markets go from AA to levered equity. It already exists. And we have this...
When you say it already exists, you mean...
collective investment schemes that offer balanced risk-rewards, that segment the risks. What we have is a knowledge gap. We have, in the financial press at the moment and in the regulatory press, we have this moment over private credit. And I always start by saying, what is private credit? And no one really knows. But the thing that I explain to people, if you define private credit as levered lending, less than investment grade, there's no appreciation that what investors are doing is they are selling risky equity and they're moving into credit. They're both investments, but it is an entirely rational decision to take risk off. If you can get near equity returns for less than equity risk, and yet they're not selling their sovereign portfolio. We think nothing of having investors buy stocks and bonds. But the regulatory mindset, because of the word credit and the association with banking, does not fit for investments that go up and down every day. And in the U.S., part of the reason the capital market has developed so robustly and the product set is because of the long history of financial market regulation through the SEC and how dominant it was. In Europe, much of the Draghi 188 recommendations go in this direction, is to recognize that if you want an activity to take place in the economy, you have a choice. That activity can take place in the government-guaranteed regulated banking sector or in the investment marketplace. But the solution is not to make the investment marketplace like the government-guaranteed funded short banking sector. And that knowledge gap, because the financial markets understanding, particularly of modern financial markets, is just lacking in so many places.
Just to build on that, I think the key insight that's emerging from what Marc just said, and sometimes it's lost on people, is that credit or the act of lending in and of itself is not where the risk lies. The backing for that is where we should focus on. So actually the way to look at it is this a deposit-taking institution? If it's a deposit-taking institution like a bank, then when it lends, I think regulators need to watch over it like a hawk. Then you have capital rules, liquidity rules, because the cost of poor lending would be insolvency and loss of deposits. And that's something nobody wants to see. But if the source of funding is not retail deposits, if it's from the capital markets or somewhere else, then it's a different proposition, even if you're doing the same activity of lending or credit. So I think that distinction needs to be made sharper. And that's one way in which risk is then treated appropriately across the two spheres.
Marc, when you said that private credit is having something of a moment with the financial press, not surprisingly, somebody asked a question. And what you were referring to, if I may summarize, there have been a handful of bankruptcies among private borrowers in the United States, a few sudden write-downs of debt on people's books, and many questions about the credibility of asset valuations, and of course, the CEO of the world's biggest bank, Jamie Dimon, made reference to cockroaches, and that got everybody excited. Are these worrying signs to you?
No. And I'll repeat a little bit of what I said yesterday. And Jamie, I think, walked back the notion of cockroaches yesterday. But
this is yesterday being
in GIC Insights.
Yes. Okay. So, just so everybody understands, GIC, one of Singapore's two eminent sovereign wealth funds, had both Jamie Dimon and Marc as speakers.
So I think that the failure to appreciate both of those companies, I don't know if they're private credit or not. They were both funded and underwritten by the banking sector. And I ask a series of questions like, is a private loan to a public company private credit? I don't know. And we keep going through this definitional issue. But I would say the following. The size of the private credit market, as I see it, is some 41 trillion. Most of the market is investment grade. A fraction of it, some 2 trillion, is below investment grade levered lending. And so much of the focus is on this notion of levered lending and the tricolors and the first brands. And if you think about what's happened, the shock from tariffs has now adjusted into the economy. The shock from high rates has now adjusted into the economy. Credit stats are actually improving rather than declining. That does not mean we will not have late cycle banking behavior, because there are good banks and bad banks, and good insurance companies and bad insurance companies, and good asset managers and bad asset managers. But there's nothing that I see that is systemic. I think what we miss sometimes by being focused on these couple of unique things is we miss secular change. Technology change is going to cause massive dislocation in the credit market. I don't know whether that's going to be enterprise software, which I could make the case is going to benefit or be destroyed by this. As a lender, I'm not sure I want to be there to find out. That's not part of the nomenclature or part of the dialogue. Businesses everywhere are going to be forced to adjust. Your competitor who adopts new technology is going to be totally different. The big secular shifts are what cause credit dislocation and credit losses, not, in my opinion, bad underwriting by one or two institutions. In this case, banks.
Is that what you were talking about or making reference to when you said recently that Apollo was taking less risk as a firm, less risk on behalf of its clients? Do you feel like, I have to ask because I think people here are interested to know, do you sense a storm of sorts building?
It's not the storm. It's that, the investment landscape, as you've been hearing, is very confusing, but it's also very straightforward. I ask our clients 3 questions. Are prices cheap? No. Second, are long rates likely to plummet? I don't think so. Most of what we're doing as a world, from deficit spending to fragmenting labor to fragmenting trade, is inflationary. And 3, do we have heightened geopolitical and other uncertainties? Yes. If those 3 things are true, the rational response is to take risk down. And then how do you take risk down? Well, in credit, you move up in credit quality. In equity, you try to reduce volatility and reduce bet. If you look in history from the market levels that we're at today, in history, the market would tell you that equities will produce 0 rate of return over the next 5 years. Is this time different? I don't know. But we're given certain signposts, and the signposts to me are saying this is a time to take risk down as an investor.
Ravi, put your central banker's hat back on for a moment, if you would, and tell us, have you, from where you sit now, seen risks building in the financial system that concern you?
Yes. And I think it's a combination of the risks that Marc just mentioned. The macro risks, the long-term macro risks are higher. I referred to the public debt situation. I think that's going to get much worse in the major advanced economies. And the question arises, who's going to buy all this? Who's going to buy all these so-called risk-free assets? They're not risk-free anymore. And I think people will start imputing risk into these government bonds. So public debt worries me a lot. state of the financial system at its core in the banking sector, I think it's pretty decent, thanks to the reforms of the last 10 years. Our separate question is it performing its role in the economy as it should? Maybe not quite as well, but at least it's not going to trigger a crisis. Then I think we have, in a sense, a leakage of finance to outside the banking sector. And there it's a very heterogeneous environment. Some of them are doing well, risks are well contained, others less so. So that bears close watching, because this is always a dilemma in regulation, that as you regulate one sphere to address a problem in that sphere, risk is almost like water. It always finds a way out to fill other places. So you've got to keep tracking that. And you have to make sure that the risk goes to places where the people who are going to bear it can actually sustain it.
Well, I knew that our panelists here would give us plenty of food for thought, and you both certainly have. Marc and Ravi, thank you very much. Ladies and gentlemen, please join me in thanking our panelists.